these magic times and what happens around them. Okay, so if you look on the top of every one of my charts or your chart, you're going to see something up there that says NQ 1215. Okay, and that's just the symbol, the NQ symbol that we're trading. Okay, and 1215 is the contract expiration, and that's December 2015. Okay, December 2015 is expiration. So there's a date on there, but the date is always the third Friday of the contract expiration month at like 8:30 Central Time. So right at market open, I think is what it is. I think pretty sure it's 8:30 Central Time. That's contract expiration. Okay, so in December, it's December 18th. Yeah. And then the next one will be March. So the next contract we'll see will say 315 or 316 on the top of my chart. Okay. And then the next one will be in June, 616. And then the next one will be in September 16, and then December 16. It's always the third Friday. Okay, so we want to start watching out at least 2 weeks before. Okay, and maybe even a little more than 2 weeks before. We want to start being aware of that contract shift. Okay, and you don't know exactly when it's going to happen. Typically, it's Friday the week before or Monday. That's when you see the big shift, okay, which would be this Friday coming up in 2 days or Monday the 14th. Okay, I mean, I've seen it go a little bit farther into Tuesday or Wednesday, and I've seen it actually 2 weeks prior start to shift over. Okay, but it's fairly rare that you see those extremes. Usually it's, you know, right about that week, 1 week before. It's a very, very volatile time. Okay, and I'm going to start talking about the reasons, but you know, first I want to tell you what you're going to expect. You're going to expect much higher volume. Okay, you're going to expect craziness, a lot of chop up and down, like this kind of stuff. Okay, you're going to expect sometimes that certain indicators that would normally work will not work at all. Okay, it's probably if you want to schedule a vacation, contract expiration is a good time to take a vacation, along with any holidays. So you can see the last 3 days. Okay, Monday was fairly normal, you know, 225. Then we got up to 328 on Tuesday, or 315, and then yesterday we were up close to 400,000. Okay, and you know, we'll see what today is like. Today might be even more. Okay, so heavy volatility, a lot of trading going on. Now, what's causing this? What's you know, going on in the market to cause all this excess volatility? Well, there's different kinds of traders. Okay, we're scalp traders. You know, maybe some people call us swing traders, but we're short-term traders. We're trading on technical analysis. We're using price action. Okay, and you know, there's a lot of people that trade like us, but there's also a lot of people that trade differently. And if you go to the CME Group's website, okay, and let me see if I can find this for you. If you follow this right here, and you're going to see there's something, here's the estimated volume, and here's the open interest, 320,000 contracts. Okay, what that means is what's left over, what people are actually holding in positions. Okay, and yesterday was 323, and Monday was, well, Monday was a little higher, so we had a little sell, 325. Okay, Thursday, 340. Okay, so it really hasn't moved that much. So 340, let's say we're 20,000 contracts less. But the volatility is still kicking up. So what you're going to see is this is going to go down pretty quickly. Okay, and this is going to go up. And what that's saying is that people are moving out of long-term positions into either cash or into the new contract because they don't want to own this thing. Okay, it's not their position to own this thing. Their position is to make money on a long-term trade. So if you look at the daily chart, this contract opened up in September. It's way down here. Here it is right here. So if you bought into a long position, you probably bought in somewhere down here at 41 something, maybe even as low as 40, 50. And now it's up here almost 500, 600, 700 points higher. That's a pretty big profit. If you bought in at that low and rode the thing up. So those people are cashing out. They're not at all concerned about technical lines. Okay, they're just saying, hey, we were up at the high a few days ago, and look, we never broke through that. This trade's over. We've come back down. We've hit it again. We've come back down, and now we're off the highs by maybe 100 points. You know what? I'm going to cash in my chips. Okay, because I don't think it's going to go any higher. And, there's probably a good chance that it could probably reverse and go back down. So I'm all out. So they walk up to the cashier and they say, cash me out. They close their positions. Okay, and they might have 10, they might have 50, they might have 100 contracts long term, and they're done. And they don't care about what the market's doing. So if somebody goes in at, 7:30 or 8 o'clock in the morning and closes out 100 contracts, that could have an effect on the market. If 200 people go out and do that, guess what? It's going to have even more of an effect on the market. So that's where this volatility starts coming in. That's what you see is people closing out positions.